The Morgan Report with David Morgan.
David Morgan with you with the weekly perspective for the week ending 24 May 2019. Well, I've got our blog up here, and I just encourage everybody to come to themorganreport.com. Most of you have signed up for our free newsletter, which comes out during the week and always on the weekend with this video update, which is also a podcast. So let's dive right into it. I usually like to start with the stock market, and this week we saw selling intensify, and the Dow was trading below its 200-day moving average. The NASDAQ and S&P are dropping toward theirs, and if they don't hold, I expect to see a test of the March lows. And to reiterate something very important, I am a strong believer and think I can prove over time that the gold market is inversely correlated to the stock market and moves more anti the stock market than it does the dollar. Yes, there is a very high correlation between the U.S. dollar and gold, but not as much as there is the stock market. So my contention, as I've said for weeks, is that for gold to move to the next level, we really have to see some weakness in the equity markets. Maybe that's beginning now, maybe not. Time will tell, but be advised. And the smart money, by the way, is moving out of equities and into gold very quietly, as very few people know. And what is known amongst the gold bugs anyway, the few that are remaining, is that the central banks have bought a lot of gold over the last year. In fact, the highest amount they've bought in the last 6 years. So the shift has begun. It's just very subtle. It's rather stealthy, and no one's really aware of it, but it is beginning. And just a little further on the stock market, the transportation index fell below the 200-day moving average. Remember, I am a believer in the Dow theory. So if you have the industrials confirmed by the transportations, look out. So again, I'm not saying this is it, that we're going to see weakness. I think we will. That's the trend right now. But with the working group on financial markets, etc., it's pretty tough to make these calls, even if you're good technically and you're good fundamentally. There's interventions all the time. Enough said. Let's move on. First article up from Charles Hugh Smith. I'd love to meet this guy in person sometime. We think a lot alike. Won't read the whole article. The headline's probably enough, but technology is not just disruptive, it's disastrously deflationary. While artificial intelligence garners the headlines, the next wave of disruptive technologies extend far beyond AI. As the chart of technologies rapidly being adopted shows, this wave includes new materials and processes, as well as the quote-unquote usual suspects of machine learning, natural language processing, data mining, and so on. So I'm going to pause there. This is not in Charles's article, but there's going to be and is a huge disruptive situation going forward, which means driverless automobiles and trucks, and think of what that would do to the trucking industry. A lot of robotics that's already in place, but further sophistication in the robotic field, which will displace even more workers. And this is one of the reasons, so this big push for universal basic income is like there are not going to be enough jobs for the populace at large, not only in the United States, which is only 5% of the world's population, but the world at large. So big disruptions coming. Suggest you bookmark Charles' website, and there's very little I disagree with on what he writes and what he says, his interviews, etc. So always a good place to try to catch up with. Time being your most valuable asset, this is a place you go, and I don't think you're going to waste your time. Again, I think I'll just do the headline only. Mish talk. Mish is pretty well known. He used to be on the George Norrie program. I don't know if he still is. I don't listen to that show much, but he's got a pretty good head on his shoulders. I've actually been with him at one conference. We didn't really hit it off, but that's immaterial. It's all about the principles, not the personalities. The Purchasing Managers Index, quote, consistent with GDP growing at an annualized rate of just 1.2%. Couldn't agree more. This 3.2 that we heard last month and on it goes is ridiculous. If you really look at the true numbers and what's really happening, if we've got a growth rate of 1.2% and the money supply is growing at a far faster rate than that, then what's really growing? Is it the money supply is boosting the GDP? I'd argue that it is, or at least partially. So article you can read, well written as always, and he always, not always, but sometimes puts some funny stuff. Again, don't know the man very well, but regardless, he puts out good information. Next up, straight from Reuters, drop in German business morale points to meager growth. Well, anyone that looks at the economic situation, and particularly the euro, knows that Germany is basically the anchor of the whole euro system and the most productive country, and on it goes. So this is not good news, and is in my main theme that I preach week after week, which is basically that the physical economy is really not doing that well. We're in a contraction mode rather than expansion mode, and all this growth, and there are some areas of growth. Most of the growth is in the money supply. Real growth, there's very little of it around, and so this article basically backs that up, and now you can throw Germany into the mix, coming from the mainstream. Reuters reports this. And on the same theme, this is the Economic Collapse blog, certainly a little bit slanted or biased, but nonetheless, I think worth paying attention to. Headline, even before recession has officially begun, some large U.S. firms are laying off thousands of workers. If the U.S. economy is booming and very bright days are ahead, then why are many large U.S. corporations laying off thousands of workers? Layoffs are starting to come fast and furious now, and this is happening even though the coming recession has not officially started. Of course, many are convinced that they are actually in a recession at this moment. You can count me in or close to it. In fact, according to John Williams of shadowstats.com, if the government was actually using honest numbers, they would show that we've been in a recession for quite some time. But the narrative that the mainstream media keeps feeding us is that the U.S. economy is doing well and this outlook for the future is positive. Well, if that were true, then why are big companies laying off so many workers right now? Let's talk Ford Motor, approximately 7,000 workers. Let's talk Nestle, approximately 4,000 workers. What about 3M, 2,000 workers? What about MGM Resorts? MGM Resorts International, down 2.5%, plans to cut about 1,000 positions. Dress Barn, laying off workers. So there's a few more in here, but I think you get the idea. Certainly, if we are in an expansion, good times are here, etc., there would be hiring of people, not firing of people. And last up, before I move to the precious metals, Wall Street Journal opinion section, the dollar may be knocked off its pedestal. America's competitors, friend and foe, have opportunities to challenge the U.S. currency. Will the U.S. dollar lose its status as world's preeminent currency? Well, we know it will eventually. The consensus is no. It said that any move away from the dollar would take decades. This view is too complacent. And it goes through and explains a lot of things. I just want to add my 2 cents onto this. I think there will be a run to the dollar as things unwind. At the same time, there's a run to gold. Big believer in the extra pyramid. I've done many discussions on that. You can look at older videos or look it up on the internet. The Run to Gold site does a good summary of the extra pyramid. But when liquidity is needed, most people think liquidity is dollars, U.S. dollars. And in a large part, they're correct. So I actually think we'll see a dollar run, and the smart money will be moving into gold. And then later in that cycle, that manic panic phase where the stock market is selling off, bonds don't look so sweet, and there's really no place to run except perhaps the cryptos and the precious metals. At that time, you'll see a run to the dollar, and then later people will think, wait a minute, these dollars are losing value. What am I going to be able to buy next month, next year with these dollars? Where can I go? And that money will start moving into gold. So you're going to get this kind of double bounce in gold, or double parabolic. I just made that up. But you're going to get a pretty big move. I still think that is at hand. Certainly that's what monetary history shows us. Things are not as solid as the mainstream press is telling us most of the time. So let me move on, make a few comments on the precious metals, and close out this weekly. 4 reasons why central banks are rapidly buying gold. This is from the Birch Group. I don't know them. I can't vouch for them, but good article. So inflation is on the rise, especially if you look at John Williams' work. Debt, and more debt. So that's number 2. Number 3, the dollar continues to weaken. Well, sort of. I mean, it's weaker than it was back, years ago when the dollar index was at 120. But I'd say it's kind of flat right now. But regardless, from that perspective, it's weakened. And then, of course, the trade war concerns with China. And then, of course, they're selling their product, which they're gold dealers, and they're talking about your retirement. Now, I have to agree, I'm not going to vouch again for Birch Gold Group or be positive or negative. I'm neutral. I don't know enough about them to say one way or the other. What I am saying is that everybody really needs some hedge, and gold is the best one. But nonetheless, very few people will take action on that statement until it's obvious. And then when it's obvious, gold will probably be running into the thousands of dollars per ounce, like 2,000, 3,000, 4,000 an ounce. But regardless, you've been educated. Anyone that listens to me is probably well aware of that fact. And last up, small gold article, Russia's central bank's gold reserves rose 2,152.36 tons in March. Russia added about 500,000 ounces of gold to its reserves in March. Russian gold reserves are the fifth largest central bank holdings in the world. Russia added a record 271 tons of gold reserves in 2018. You can see this chart, and basically we know why. They're hedging against the dollar. So, of course, so is China, as are the BRICS countries. And I'll have to mention silver real briefly. I mean, silver cannot get off the mat. The gold-silver ratio is at 88 to 1. You can buy 88 ounces of silver for 1 ounce of gold. When I started my original website, well, not the original, which is the back URL anyway, I digress. My original website that's well known, silverinvestor.com or silver-investor.com, the ratio is 80 to 1. And I felt strongly at that time that that was the highest ratio, highest number we would see. I didn't dream that 19 years later we would see a gold-silver ratio at 88. Nonetheless, that's where we are. I have not given up on silver. A lot of people have. I don't think there's an asset class that's more hated right now than silver, because most people that have bought it are at a loss if you convert to dollars. By the way, let me digress slightly on the gold market, and this applies to silver in a cursory way. But, you know, we, and I'm guilty of it as well, we constantly look at the gold price in terms of U.S. dollars. But remember, the U.S. population is 5% of the world. So, you know, if you're looking at gold and other currencies, it's not bad at all. In fact, you're probably happy that you own gold. There's a pretty good article about Venezuela and people that own gold there. So, you know, we're taking a perspective of 5%. Now, of course, the dollar's dominant and all that, and I can't discount that too much. But the point is that if you're looking at dollar-centric only, gold looks lousy. And most of my audience is North American. It's like 60% U.S., 40% Canadian. Although it's worldwide, we have Morgan Report subscribers worldwide. It's translated into German, it's translated into Spanish, and it's translated into Mandarin. So it's in 4 languages: English, Spanish, German, and Chinese. Regardless, the world view of gold isn't as negative as the U.S. view of gold. I just want to point that out for everybody. Back to silver. I think gold has got to make a move before silver does anything this time. Once it does move, I do believe strongly that the ratio will be coming down, meaning it won't be 88 to 1. And where will it go? Will it go to 40 to 1? Will it go to 16 to 1 or even 10 to 1 that I wrote about, almost 20 years ago? I don't know. What I do know is that silver is undervalued vis-a-vis anything that you want to name on a planet, including gold. But I wouldn't overload, and I'd be patient. I don't think we're going to see much in the metals until probably the last quarter of this year. Nonetheless, I still believe that the last move up in the metals is ahead of us, and it's not that far away from a bigger perspective, meaning 2-3 years, something like that. Closing out, wish everyone the best. Have a great weekend for those that are U.S. based. Happy Memorial Day coming up, I think, on Monday. And I will be back with you next week. Remember, there's nothing more powerful than the truth.
Hello, I'm David Morgan, publisher of the Morgan Report. And as some of you may already know, the Morgan Report is about money, metals, and mining. In fact, we cover all resources from rare earth elements to precious metals. I've been publishing on the internet for about 20 years. My primary passion is to help people build and preserve their wealth. I love to make people millionaires. I've helped thousands of people via our research in the Morgan Report, which has thousands of paid members and 10 times that amount on our free weekly updates. Here's what you'll receive from our free newsletter. To-the-point webinars, weekly analysis of the financial markets, interviews and our conference schedule, special reports such as riches and resources, and various metals price forecasts. Our paid service client base is primarily small to medium-sized business owners, professionals in the industry, or the seasoned investor who understands markets and the value of precious metals. My area of expertise includes equity analysis throughout the resource sector, energy metals, base metals. We cover startups to billion-dollar corporations. We focus on a special sector that makes money regardless of price oscillations, and the importance of precious metals due to the ongoing currency devaluations. Our team of 3 analysts and support staff can help you build and protect your wealth. It's important for you to know what other people have said. We're passionate about what we do. High integrity and trust. Tell the truth and own it. If we're wrong, we admit it. Take a long-term outlook with major assets and bet a little to win a lot with speculative situations. If you choose to become a client, you will gain financial insights very few, even professionals, recognize. You'll understand the importance of honesty in our financial system. You will understand how the money system influences almost everything in your life. You'll be prepared for the ongoing currency crisis. And finally, I've chosen to make my life's mission greater than the individual, which means my mission statement is to teach and empower people to understand the benefits of an honest monetary and financial system. It's been a great journey so far, and the best gains in this sector lie ahead over the next 3 to 5 years. I'm fortunate to have earned the status of being a leading authority in my field in helping others protect their wealth. You can email me at support@themorganreport.com or call my office at 480-325-0230.